Well, hello, everybody, and welcome to the Deckman Wealth Management 2023 Economic and Investment Outlook. We have a lot of great information that we're going to cover with you here today. And without further ado, let's jump right in. We would encourage you to ask any questions you might have. If you do have a question, at the bottom of your screen, there'll be a Q&A box. If you just click on that icon, you can type in your questions. We're going to take all the Q&A at the very end of the discussion, but while it's fresh and you're thinking about it, please note the question, and we're going to do our very best to get to each and every question that is sent to us. Important disclosure information, nothing that you haven't seen before. Next page. And more disclosure information as well. This is your good-looking staff here, your certified financial planners. You have Sam Deckman, who will be conducting today's webinar, and his twin brother, Adam Deckman, also a CFP, Certified Financial Planner. And the three of us are the Deckman team, here to serve you and work with you as you have needs and wants. So let's go over the agenda. A couple things I want to point out. We do record each and every one of the webinars, and no different, we will be sending you a link to this webinar that you're listening to right now. Those are generally sent out a week following. So probably by the middle to end of next week, keep an eye out for the recording along with all the slides that we're going over. So our agenda is robust. We have a ton of information. First one we're going to discuss is interest rates and inflation, labor market and wages, what's the outlook, and the new Secure Act that was just passed. Major retirement changes. We're going to touch on the high points, but there's a lot more to it than what we're able to cover in the time allotted. The last item are investment strategies for 2023. The presentation itself is about 45, 50 minutes, and then again, we'll allow some time for Q&A. Would encourage you to stay throughout the entire presentation as we go through all this important information. On that note, Sam, please take it away.
Yes, thank you, Jordan, for the introduction. And as he stated, we're going to be going over a lot of different topics. And last year was a very interesting year. And so as we're going over the data of last year as well as the data looking forward, we're going to be going over a lot of things that weren't so good and some things that were. It was really a story of Jekyll and Hyde, and that same theme is still occurring at this particular moment. So let's just jump right into the two biggest focuses of the financial markets right now: interest rates and inflation. So this first graph that we are taking a look at shows us what headline inflation has been since January of 2022 through January of 2023. So what headline inflation includes is everything. So you may hear on the TV or different internet publications, headline versus core inflation, or CPI is another way to refer to it. So headline includes everything. Core inflation excludes both food and energy. And so what we can see in this particular chart is that inflation from January of 2022 slowly increased all the way up until midsummer of 2022, where it peaked at 9.1%. It was some of the highest inflation readings that we have seen over the last 40 years. And since that point, we have slowly seen inflation start to come down to a level where we were at from the January figure of 6.5%, which is still very much above the Federal Reserve's target of 2%, but at least it is encouraging that things are moving in the right direction. And along that front, apartment rents fell in every major metropolitan area in the US over the past 6 months through January, a trend that is poised to continue as the biggest delivery of new apartments in nearly 4 decades is slated for this year. According to estimates, nearly 500,000 new apartments are coming online in 2023. So that is a very encouraging trend. Another major factor impacting inflation is the money supply. The money supply, measured by what we call M2, soared during the first 2 years of COVID. It was up over 40% from February 2020 to February 2022. But in the last 10 months of 2022, the M2 measure of money declined by 2.3%. With less money in circulation, that means there are less dollars competing over a good or service. So hopefully this will apply some downward pressure on prices. So we're seeing the supply increase for rents, which is a huge part of shelter, that in this bottom thick blue column, and also the money supply is going down as well. And we're about to talk here on the next slide about interest rates. But with interest rates going up, it makes folks more, it incentivizes folks to save their money versus spend it. And so we'll talk about how that might be able to help inflation as well. And so what we're looking at here is a graph showing the federal funds rate going all the way back to 2000 through to today. And so there's a couple things that I want to point out from a high level historically. One, we can see over the last 20-ish years that we have experienced periods of much higher inflation. You can see right up to the lead of 2008, and then also interest rates were significantly higher in the 2001 area. So even though we have increased interest rates significantly from where they were over the last roughly 10-ish years, which was basically zero, we are nowhere near the highest we've ever seen them, and certainly not the highest we've seen them in recent history. So the Federal Reserve recently increased interest rates by 25 basis points, which is 0.25% at their last meeting, which is a smaller increase than their meetings in December and November, where they raised interest rates by 50 basis points and 75 basis points respectively. That is 0.5% and 0.75%. Federal Reserve Chairman Jerome Powell, in his speech to the Senate Banking Committee today, said the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. This got the market thinking that, okay, while they did raise interest rates 0.25% at their last meeting, they seem prepared to potentially up that again to either 0.5% or data dependent, potentially even more. The Fed's next meeting is scheduled for March 21st and 22nd, where they will determine if they want to raise interest rates again. They will also give their projections of where they expect rates to be in the future. The market's expectation right now is that the federal funds rate will increase to 5.5% to 5.75% by year end. However, this could go higher based on the February jobs report and inflation report coming out in the next 2 weeks. And this is a massive shift versus where we began, 2022 in particular. So let's just take a quick second and understand why they're increasing interest rates. They are increasing interest rates because they are trying to tackle the inflation that we saw on the previous slide. Headline inflation was 6.5%, and what they're trying to do is get that down to 2%. So one of the levers that they're pulling is they're decreasing the money supply. And then the other lever that they're pulling is increasing interest rates. when you increase interest rates, it makes everything more expensive for you as an individual and for businesses at large. When interest rates are higher, it makes it more costly for companies to go out and borrow money, to invest in that extra factory, to hire those extra workers, to purchase more inventory. It makes it more difficult for you as an individual because if you're trying to buy a home, your mortgage rate has gone up very significantly. And now that interest rates have gone up from 0, you are now being incentivized in a very compelling way to actually save money and put that money in the bank and earn, and we'll go over this towards the end of the presentation, a pretty considerable interest rate. And so the hope is that by increasing interest rates and continuing to raise them, that's going to normalize inflation. And at some point, once the Federal Reserve feels that they have that under control, then they will lower that. But the message today came across pretty clear that they're going to keep them higher for longer than expected. And we think that that is a huge divergence from what the market had anticipated. We believe that the market's expectation was a little bit more rosy in terms of the future path of interest rates than what the Federal Reserve shared today. So what we wanted to show you was a chart which we call the yield curve. And if we're looking at the top dark blue line, this shows you where the yield curve is today. In the bottom gray bar, that shows you where it was December 31st of 2021. So some of you may have heard about what an inverted yield curve is, so wanted to spend a few seconds talking about that. But let's just look bigger picture. Let's look first at the bottom at the December 31, 2021 chart. So this is what a normal yield curve looks like. So if we start on the left-hand side, we can see it says 3M. That stands for 3 months. And then the Y's next to those other numbers show the years. And that's on the x-axis. And on the y-axis, that shows the percentage yield. So what we see during normal times is that if you're going to loan your money to the federal government for a longer period of time, they will pay you more interest. That is because that money is going to be subject to inflation. And not when it comes to US government, but other borrowers, the longer you loan your money to someone, the more risk there is that they may not return it to you. Now let's look at the upper end of the graph, and we can see that it does not look like that. Whereas we can see on this particular chart that the 1-year figure is significantly higher than you loaning your money over 5 years or 3 years or 2 years. And so what does that tell you? That tells us that the market is anticipating that we might be expecting a recession in the near-term future. And that if there is a recession, the Federal Reserve will lower interest rates. And so this is what an inverted yield curve looks like. And generally, it's a pretty telling sign that a recession is likely just around the corner. And so one other final point before I move on to the next slide is I want you to take a look at the difference here on the far left-hand side. How significantly we increase short-term interest rates barely, a little over a year ago. Short-term interest rates have gone up over 5% where they were. And this has caused a lot of the indigestion, if you will, not only in the bond market, but particularly the stock market of last year. So this massive increase from where we were to where we are now sort of explains the major disruption going on in the bond market. So now we're going to spend a second and talk about what's going on in the labor market and how that relates to wages. So this first chart that we wanted to show you looks at the number of job openings to job seekers. And so what we can see from this figure here on the right-hand side is that there are 1.93 jobs available for every 1 person looking for them. So there's roughly two jobs available for every 1 person looking for them. And this is an absolutely incredible number. And you can see that this is significantly above anywhere that we have been over the last 50 plus years. And so this is one of those items where we have some good with the bad. This is good if you are looking for a job because it means that employers are fighting over a limited applicant pool, and you can have or show a little bit more negotiating power, if you will. But this is bad if you're an employer because it means that it's very difficult to find people to work for your particular company. So let's look here on the next chart as well, which shows us the unemployment rate in the gray line and the wage growth in the light blue line. And this is looking over the past 50 years. So the US added 517,000 jobs in January, according to the Labor Department's January jobs report. And the unemployment rate dipped to 3.4%. This is despite a wave of recent layoffs announced by major companies and concerns that the Federal Reserve's interest rate hikes would spark a recession. Leisure and hospitality added 128,000 jobs, the most of any sector, but it still remains below pre-pandemic levels by 495,000 jobs. Food services and bars also led the way, adding 99,000 jobs. Of the more than 100,000 layoffs announced last month, the highest monthly figure since September 2020, around 40% were in the tech industry. And so in the tech industry, they're seeing a lot of change and a lot of layoffs, but other industries that we talked about, hospitality and leisure, they are trying to add workers as they're still not back to where they were. And so how much lower could the unemployment rate go? We're here at 3.4%, which is a near 50-year low. We're not entirely sure, but we are seeing more folks get off the sidelines and actually go out and look for work, given that there's reporting that they are starting to or have gone through a lot of their savings, and with inflation continuing to pick up, hopefully those folks rejoin the workforce because that'll help keep the economy moving forward in a positive direction. So now let's give you an idea of what the economic outlook looks like. So this is a chart which shows the different stages of an economic cycle. We have the early here on the left, mid, then there's late, and then there's a recession. And in the light blue circle, that is where we believe the United States is, meaning that we are in the late stages of the economic cycle, but we are not quite yet at a recession. And the reason why we feel that way is because it's difficult for us to imagine a world where the US economy is in a recession after adding 517,000 jobs. That doesn't quite add up. But of course, there are other cracks that are starting to show. And so once those job figures likely start to cool, that would give a little bit more credence to the idea that we are, working closer to a recession. Now, I'm not saying that, a recession is too far off in the future. I'm just merely stating that adding almost 500,000 jobs net doesn't lead us to believe that we are currently in a recession. But you can see that other parts of the world, we do think, have already entered that territory. We're looking at the United Kingdom, other areas of the Eurozone, and China is absolutely in a recession. Now, a recession in terms of China looks a little bit different than here in the United States. A recession for China just means substantially lower growth than they've experienced in the past. So their economy is still growing at a very slow clip, but in terms of the way that we view them, they would be in a recessionary territory. Now let's take a look at real estate. And so what we're looking at here on this graph is housing inventories over the last 40 years. And the main reason why home prices are unlikely to crash is because the supply of homes is at dramatically low levels. You can see that the inventory of new and existing homes for sale is sitting at near 40-year lows. While today's housing market clearly needs more supply, we show that single-family housing starts have only slowly recovered since the great financial crisis, and more recently have started falling again due to higher mortgage rates, worker shortages, and deteriorating home builder sentiment. So while we see almost 500,000 new apartments coming online this year, we are not seeing the amount of growth in single-family homes that would lead us to believe that we could see a massive change in terms of the price of real estate. Now, it's important to understand that real estate is a very localized part of the economy. So different areas of the country are certainly seeing different price decreases, but at least as far as we're concerned here in the state of Colorado, there's still a massive demand for homes, and we are not seeing the supply to meet them. So even though interest rates are higher, we think that home prices should hold up a little better than you would normally expect. You know, when you interest rate or mortgage, excuse me, some were getting below 3%, and now it's around 7%. So this is a chart which shows the leading economic index, and this goes all the way back to 1959. So this chart is supposed to show us what could potentially come about, or if a recession is right around the corner. And so there's a few things that we want to draw to your attention. Each of these gray lines that are going across the center, or excuse me, vertically, those indicate when a recession occurred. And there has never been a recession when the leading economic index was increasing. Now, if we scroll over here to this chart right here where it says last 12 months, we can see that it is going down. It is not increasing. And so this is not a perfect measure. It doesn't tell us when exactly it's going to happen, but this is another one of those indicators that we're taking a look at that leads us to believe that there is a likelihood that a recession could happen at the end of this year, and if not at the end of this year, next year. And so we, in our planning with you and your portfolios, we are expecting that a recession is going to happen, whether it's at some point at the end of this year or next year. So when it does happen, or if it does happen, it will not be a surprise to us. We are expecting it, we are planning for it, and it's something that we want to make you aware of, that it is something that we are keenly paying attention to. So we wanted to make a quick comment in regard to the federal debt ceiling, given that it has drawn at times a lot of attention in the media, and of course this is a big topic that some people are thinking about. So want to first bring up a few statistics. Since the introduction of the modern debt limit in 1917, Congress has voted to raise or suspend the debt limit more than 100 times. Yes, that is more than 100 times. The debt ceiling has been raised or suspended in response to economic crises, wars, or other events that have occurred, that required the government to borrow more money to meet its financial obligations. The most recent debt ceiling crisis occurred in 2019, when Congress and the White House agreed to suspend the limit until July 31st of 2021. However, due to the economic impact of COVID-19, the limit was suspended again. And here we are now, where the Treasury has come out and said that they are able to fund operations to likely a June timeframe of this year, at which point there needs to be a decision on what is going to occur with the debt ceiling. While it is concerning to see both sides pointing fingers and calling each other bad names, we have seen this before. In fact, it's been raised 100 times. And so it is our hope that they are negotiating in good faith behind the scenes. And the reason why we feel that they are going to come to a resolution is because nobody wins if they don't. For those who don't want to make any concessions on spending at the moment and increase the ceiling, again, without any contingencies, they will likely be blamed for further increases in inflation. And those folks who are very concerned about the amount of money that the United States is spending, which is a legitimate concern, if they allow the United States government to default on its debt, that means that we are going to have to pay significantly more in the future. So for being fiscally concerned about what's going on, they also don't want to further increase our bills. So both are going to be incentivized to come to a resolution. And in terms of if this is something that you should worry about, we have a very strong phrase here at Deckman Wealth Management that we control what we can control, and we don't put too much worrying into things that are out of our control. And so this is something that we are keeping our eye on. Of course, we do not want the United States government to default, and we are of the hope and belief, as they have done 100 times before, that they are going to come to a resolution to keep the ball moving forward. So now let's switch gears entirely and talk about a major retirement and tax law that passed at the end of last year. And so this is called the Secure Act 2.0 because this is the sequel to the Secure Act that passed at the end of 2019 that took place in 2020. And as Jordan mentioned at the beginning of the presentation today, there are many, many, many provisions, in fact, even more provisions in the Secure Act 2.0 than were in the initial Secure Act. So we are going to be talking about the big ticket items that we think apply to the most folks on this call. But it's important for you to reach out to us to see if there are other items that may apply to your particular situation. But let's go over the biggest item that affects most people on this call, and that is with the new RMD ages. And I should have spelled this out. RMD stands for Required Minimum Distribution. So in your pre-tax retirement account, which is generally a 401k or a traditional IRA, because the money went in pre-tax and the money has grown tax deferred, the government requires that you must take out a little piece of that account every single year, beginning at these various ages. So if you were born in 1950 or earlier, your RMDs must begin at 72, or for those that were born significantly earlier than 1950, then you were grandfathered into the 70 and a half RMD age. For those that were born between 1951 and 1959, your RMD age is now 73. And for those born 1960 or later, your RMD age is 65. Now, this is important to know just to make sure that RMDs are being taken and calculated properly. But with the RMD age being pushed back, it also presents a lot of other planning opportunities. One other planning opportunity that the RMD age moving back presents is Roth IRA conversions. So for those folks that have retired and are below your RMD age, with the new pushback of the ages, a Roth IRA conversion strategy now makes more sense for some people than it ever has. So it's important for us to sit down and discuss what that might look like. But I think that is the biggest implication, not only to just follow the new guidelines, but what opportunity is really going to present itself. Another major increase, again, that applies to a lot of folks here on this call is the new contribution amounts. For 2023, everyone is able to contribute up to $22,500 to their 401k. If you are over the age of 50, you can contribute an additional $7,500. So if you are over the age of 50 the total amount you can contribute is $30,000. And when it comes to an IRA and Roth IRA, the figures for 2023 for everyone is $6,500. And if you are over the age of 50, it's an additional $1,000. So if you are over the age of 50, that means you can contribute $7,500. And just a quick point about this, given that we are right in the heart of tax season, if you want to contribute to your IRA and Roth IRA for the 2022 tax year, you still have the ability to do so. You must contribute to your IRA and Roth IRA before tax day, which is April 18th this year. So if you still want to contribute for 2022, let us know so we can help get that in motion for you. Now, these are future changes. I don't want to dwell too much on the specifics of each, but wanted you to be aware of all of the items that are going to come into effect next year or in future years. So you know that there's a lot of planning that's going to need to be talked about this year and in future years to make sure that you're properly taking advantage of everything. The top one is the new post-death option for surviving spouse beneficiaries. Without getting too into the nitty-gritty with this, all I would say is that when a spouse passes, we now have more options available to us. Whereas previously, and this goes into effect next year, but next year we'll have more options available to us on how we want to process that. So of course, should this come up, just know that there are more options available and we'll want to help you filter through which one's best. The next one is a 529 to Roth IRA transfer, and that's effective next year. With a 529, if there is money that is left over after you or your children or grandchildren in most cases finishes their education, and you want to pull money out of that 529 for a non-qualified educational expense, the gains on that account are both taxed and penalized, which is of course something that we all want to avoid. But beginning next year, there is now an ability to move those extra funds to a Roth IRA. Again, there are a lot of stipulations on this, so we can go over the specifics if you're interested, but wanted to bring this to your attention. The next item here is high wage earners. So anyone making over $145,000 will be required to use the Roth option for catch-up contributions effective next year. So what does that mean? So for 2023, we said everyone is able to contribute $22,500, and those over 50 could contribute an additional $7,500. That $7,500 is your catch-up. So starting next year, if you are making over $145,000 and want to do a catch-up, you will have to put that catch-up into a Roth 401k. You cannot put that into the traditional side. The next item here is that employers can match payments to employees, employees make to their student loans. And so if you have a lot of student loans and have been paying that down, your employer now has the ability to help match those payments either by contributing a percentage to your retirement accounts or paying your student loans off with you to help tackle them much faster. And then the last one is very helpful, but of course, in true governmental fashion, make things more complicated than necessary. So beginning in 2025, only participants who are 60, 61, 62, or 63 during that year have increased limits to their 401k beyond the normal catch-up that's available to everyone else. Yes, that is strange, but if you are fitting within those 4 years, you can contribute even more money than we talked about, and that begins in 2025. And this is separate from the Secure Act, but this is very important for all of our clients here in the state of Colorado and wanted you to be aware of because this is great news. Beginning with the 2022 tax year, taxpayers that are 65 years or older may fully deduct the entire amount of Social Security benefit income included in their federal taxable income. So just to say that again in clearer English, if you are over the age of 65, live in the state of Colorado, none of your Social Security tax will be subject to Colorado state income tax. For those taxpayers who are 55 to 64 years old, you can deduct up to $20,000 of your Social Security benefits from your Colorado income taxes. So that's a really great thing that is going into effect for last tax season. So now let's shift gears and talk about investment and planning strategies for 2023. We gave a lot of numbers and statistics about what's going on with interest rates and inflation and the idea that a recession could likely be around the corner. So how do we take advantage of this? What does this mean? Where do we go? What should we do? So in terms of planning strategies, we're going to begin there. So this is one of the provisions that actually occurred during the original Secure Act. So starting in January 2020, non-spouse beneficiaries are subject to a 10-year rule for inherited retirement accounts. A non-spouse beneficiary is not required to take an annual RMD, but the entire account must be distributed 10 years after the original account owner's death. Again, we are talking about an inherited retirement account. And the reason why we're bringing this up is for a few reasons. One, if you had a loved one pass away in 2021 or 2020, we are now 3 years into our 10-year window when we must withdraw the entire funds. So it's important that we have a strategy in place on how we want to withdraw those funds, because we don't want to take out a sizable portion in year 10 and put you in a higher tax bracket than necessary. And another planning component that's going to be very important to keep in mind is that there were some major tax laws that were changed at the end of 2017 in the Tax Cuts and Jobs Act. And during the Tax Cuts and Jobs Act, that lowered all of the tax brackets. Those provisions are going to sunset, which means they're going to go away at the end of 2025 unless Congress passes a law or extends those. So to put the planning opportunity in perspective, tax rates are likely going to go up beginning in 2026 unless an act of Congress happens. And we know that we must withdraw all the retirement monies from an inherited account in the next 10 years. So let's sit down, let's talk, let's revise the strategy to make sure that it's still the best one for you to keep your taxes as low as possible. Now, we talked about this 10-year rule, which applies to most everyone, but there are some exceptions. So if you are a minor child, disabled, chronically ill, or anyone not more than 10 years younger than the original owner, so all of these people have exceptions to the 10-year rule, meaning they can stretch their RMDs over their entire lifetime. So to also reframe this and put this in better English, anyone not more than 10 years younger, that means if you are a brother and your older brother who was 9 years older than you passed, you would apply for this exception because you are less than 10 years younger than that individual. If you are inheriting an account from your sister and you were 4 years older than she was, then this would also apply to you. So we want to make sure that we are taking the money out in the proper way, again, so you're not taking out more or incurring more taxes than necessary. So now let's switch over to the investment component and strategies and good strategies to be a successful long-term investor. And the mantra that we preach all the time, and it's backed up by all of the data and research, is that it is important to stay invested. It's time in the market, not timing the market. So what we're looking at here is a graph which shows on the left-hand side that we stayed fully invested over a 20-year time frame. And the bar chart to the right of that shows if we missed the 10 best days over a 20-year time frame. And you can see that it is significantly lower, less than half. And then if we go one more bar chart to the right, this is if we miss the 25 best days over a 20-year period. We can see that it's roughly about a fourth of where it was. So in this black bar is also another very telling statistic, that over the last 20 years, 24 of the 25 worst trading days were within 1 month of the 25 best trading days. So put very simply, it is impossible to know over the next 20 years when those best days are going to occur. So it's important to make sure that we stay fully invested, because we can see here very clearly that the costs of missing out on those best days by trying to time the market, which is an impossible endeavor, can cost you severely over the long term. So again, the most successful strategy is to remain invested, but of course you want to make sure that you are intelligently invested and in the right areas of the market. So one of the indicators that we take a look at, among many, is consumer confidence. So what this is looking at, and I know there's a lot of numbers here, and so let's just spend our time looking at this part of the chart that is highlighted in yellow. So what we have found is that when consumer sentiment peaks, the next 12 months of return are significantly lower than we have reached those 8 sentiment troughs. So this is a contrarian indicator. What this is saying is that when people are overly optimistic about the stock market, or rather euphoric, that is generally a signal that the market is likely going to experience some tougher times. Whereas on the contrary, when people are most pessimistic about what the future holds, we can see over the last 50 years that that has generally been a great buying opportunity. So if we scroll here to the right, this green dot shows us where we were in February of this year. And so we don't know if we reached the trough at some point in January, perhaps, but it's interesting to note that we are significantly below the average, and as a general trend, people are more pessimistic than they've certainly been in recent years. And so if the stock market is not something that excites you at this moment and you're still a little nervous, given that interest rates have gone up, which has caused a lot of volatility, it's also presented a fantastic and amazing opportunity for cash. And that investment opportunity, I know we've been talking about it religiously over the last 6-ish months, is the United States Treasury bond, or we refer to it as a T-bill. Now, a T-bill is issued by the United States Treasury, and it is backed by the United States government. So you are guaranteed this rate of return by the United States government. So what we can see is that over the 3-month period, you're earning 5% on an annualized rate, 6 months, 5.24, 9 months, 5.25, and a 12-month period, 5.32%. Now, why do we like them so much? Well, number one, you are guaranteed this rate of return by the United States government. 2, we like them better than a CD, because in a CD, when you select a term and you want that money before that term, you must surrender the CD. And when you surrender the CD, banks will charge you a penalty. And all of them are a little different, but generally it's about 3-ish months of interest. Whereas with a Treasury bill, you are able to sell at any point in time, and there is absolutely no penalty for doing so. Next, the interest that is earned on a CD is both federally and state income tax. Whereas with a T-bill, you are taxed on the federal income tax level, but it is not included in your state income tax. So interest rates are significantly high. They are guaranteed by the United States government. You can sell and get out of these without penalty at any point in time, and it is not taxed by your state by state income taxes. So if you have cash, instead of letting it sit and get eaten up by 6% year-over-year inflation, we would encourage you to strongly consider a US T-bill where you are now earning a pretty substantial interest. So let me turn it back over to Jordan to summarize the main points of the presentation today and to bring it home.
Thank you, Sam. So Sam brought up a lot of interesting points, a lot of information to digest, but we would again emphasize that the most successful investors focus on the long term, but more importantly, have a game plan and a strategy. That's where we come in. That's where we can help you. Investing cash into T-bills or treasury bills, if you will, is an excellent strategy to get your money working even better for you. This is something that we help you with at Deckman Wealth Management. It is something that we provide as an added value service and want to at least help you look at the numbers to see if it makes sense for you. The third item is understanding this new Secure Act 2.0 and take advantage of future opportunities. Some of the planning opportunities are in effect right now, but others go into effect 2024 and 2025. And we could do a little advanced pre-planning and make sure that you are taking advantage of those opportunities. And as always, we encourage you to schedule an appointment. Please call the office. Our phone number is listed. Obviously, we're not going to be there at this moment, but call us and we will welcome the opportunity to meet with you in person. We could do a Zoom call. We could talk on the phone. We are never too busy to help you. So on that note, let's go to the next item, which is the Q&A. I see some folks have already inputted some questions. If you have something on your mind, please note your question. And again, we have so many questions here. I'm going to do my very best to get through that here in the next several minutes. The first question we have is about Roth IRA conversions. What's your opinion? What's your philosophy? What do you recommend as far as Roth IRA conversions? Well, I'll take that one. Sam went into some of the planning opportunities, particularly the sunset of the tax law changes that were both implemented 2017 and 2020. Those do sunset, which means they expire in 2025. It's almost inevitable that tax rates are going up and going up quite a bit. So there are some planning opportunities this year, 2023, next year, 2024. So let's see if we can't get ahead of that. Roth IRA conversions are one of the planning possibilities. Okay. Wow, this is a good one. I like this question. Are you concerned with the geopolitical situation relating to Russia, China, North Korea, Iran? Yeah, who isn't? We're all hyper concerned about that, very much so. I think Sam touched on that earlier, that we do focus on the things that we can focus on where we have control. And these are what if scenarios. It's too hard to predict, and no one knows exactly what's going to happen with regard to these regimes. All right, next question. What should I be doing with a potential recession on the horizon? That's a really good question. I would say in simple terms, make an appointment, meet with us immediately. Everybody's situation is different and unique, and there's no one answer that we could say fits all scenarios. We want to be best prepared in advance, and we are absolutely hypervigilant about a proactive approach and where we monitor and review on a regular, ongoing basis. But again, we encourage you to give us a call. Let's schedule a time for us to meet and talk. Another question, does the T-bill need to be new money? No, it doesn't. We can use existing monies within the existing portfolio. Boy, oh boy, I am just wondering if there's anything else. Sam, anything else that you might add before we conclude here?
No, I think that was great. And in the interest of time, I think it might be good to just actually answer all these questions offline.
Absolutely. Well, at this point, I would like to go to the next slide here and say thank you to everybody. Again, please call us, send us an email. Let's schedule a time to meet and go over your questions and concerns. We are very grateful for the privilege to serve you, and thank you very much. Thank you. Have a good rest of your day. Bye-bye now.
Thank you.